program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tosaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome to the Option Block, everybody. This is Mike Tosaw. I am your host today. Mark Longo is ailing today, so we are filling in his footsteps as best we can. And we're excited about today's show because we have a lot to talk about. This is our first show of 2013, fresh year, fresh attitude. Today, on our usual, as Mark likes to put it, all-star panel, we have the usual cast of characters, starting off with Alex Jacobson from Options Express. Alex, how are you today?
Good. Happy New Year, everyone. Looking forward to a great year.
That is good. And chiming in from the great state of Maine, we have the rock lobster himself, Andrew. Andrew, how are you, and how are things out in the great state of Maine?
The great state of Maine is fantastic. It is clear and cold, so I finally have some ice, which I've been waiting for since mid-December.
Now, why do you have do you live on the water out there? Are you trying to ride your snowmobile on it, or why do you need the ice?
Well, we need ice so I can go ice skating, and I can go cross-country skiing, and the ski resorts are open. I got one 40 minutes away, so
okay.
I want to do winter stuff.
If
it's cold and there's no snow, I don't see what the point is if you can't do any winter fun stuff.
Yeah, kind of like Chicago. It's cold with no snow.
It's cold and miserable there. Yeah, I've done my time in Chicago, so I know what that deal is.
Got it.
The Trading Block.
All right, and now this is the first show, as we mentioned earlier, this is the first show of 2013, and we've had a couple of things that have gone on since the last time we've spoken. Magically, the world hasn't ended yet one more time. The heroes in Congress, the great people with which they are, they came together and they saved the world yet again with another budget deal. Alex, what are some of your thoughts on what happened over the New Year's holiday with the last-minute budget deals and all the compromises that came into play?
Well, they got half of it done. They've still done nothing about spending. I mean, it sounds like a broken record, but they only addressed half of the equation. They did nothing about spending. They took 2% from all of us back with the elimination of the payroll tax holiday, and the markets responded well. So go figure. I mean, one thing we saw here at Options Express is we calculate a lot of internal data, and we had a lot of put buying going into the end of the year. That has subsided, and our customers are now, those who buy options are buying calls 3-to-1 over puts. So we've seen a sentiment shift here, which looks like our customer base has gotten less fearful. The premium sellers here are still 8-1 puts to call, so that's clearly a bullish tone. That number actually hasn't changed much, but the call number changed a bit. So they clearly got somewhat to one side of the equation. Now we're going to see what they do on the spending side.
Yeah, I'm curious to see how this comes about, especially with the market reaction as choppy as it was over the course of this last week. We had quite the range in the VIX. Andrew, have you been watching the VIX at all?
I just so happened that I did watch it a couple times.
I figured you might.
You know what? It's an occupational problem I have. So we saw some near-term VIX futures, trade $22, something like that, maybe on Monday, 20 handle for Jan futures, and today trading around 15 and change. I mean, I think we've had probably, 2 10% down days in volatility. First, the day before, they were supposed to, that was New Year, or the day before New Year's Eve. We had a pretty good volatility crush that day. Because at that point feels like a compromise was going to happen. Then there was a couple more, moanings and groanings. And then we got the full-born crush yesterday. And actually, a big part of the crush came in the last hour of the day. So it's amazing how, what volatility is and understanding how it works. Usually the VIX is a perception of movement. And funny enough, it was pretty right. They were looking at around 20 volatility or so. And that's about the move we got. We got a pretty substantial move over 2 days, about 3.5% or 4%, something like that up. Yeah, 3% maybe. So again, that's pretty big for the indexes. And the market was pricing, did I think a fair job of pricing it. But that's one thing about pricing the movement and pricing the volatility are two different sides of the Greek coin. But yeah, now the market, volatility needs to find a bid, and I think it's going to have a hard time, at least for the next couple of weeks.
Yeah, it's come down a lot, and yeah, you're right along those lines, just because of the fact that it seems like everyone's very. It feels like we're This feels like the story of the last 10, 12 years. Oh, the world's going to end. And then the next week, everything's fine.
Well, I think that's also a function of high frequency trading, event-driven news algorithms. They're in, then they're out. And that's just a lot of money hitting the bid or taking the offer at once. And it really drives the market very, very quickly. And at the end of the year, what we up, 8 or 9% or 10% for the year? They have all this gyration, up 10%. So for an equity market. So I think intraday has gotten a lot tougher, but doesn't seem like it makes a lot of difference year to year.
Yeah, now let me ask you this, and maybe this will be a question for both of you guys. You guys have been in the business for many years. This is to me, this seems like a pretty choppy market. I remember the markets of 2008, back when I was working at Options Express, and I'd walk from the train station and pass by the Merc every day and see, the S&P's down 50 this morning pre-market. Well, maybe I'll still have a job. Maybe we'll still have an industry. Who knows? But aside from that, what are some of the choppy markets that you guys can remember from your trading careers? Because it's probably not the choppiest, but would you guys say that this is a pretty choppy market in comparison to what you have seen throughout your careers?
Well, go ahead, Alex.
Go ahead, Andrew. No, go ahead.
My problem with this market is there's no liquidity. I don't think there's really. I mean, Alex is coming back with numbers from OX customers, and OX I think services kind of a particular type of clientele, somebody who's already pretty market versed. I mean, we're talking relative to the 15, 20 million or more individual investor types. Maybe there's 25 or 30 million, who knows. But they're kind of more on the cream of the crop on the upper end of people that sort of understand how to trade options. So they're going to be in the market all the time. But as far as trying to bring everybody else to go and buy some stocks for themselves, I think they're kind of gone, and I think the market misses all that liquidity. So I think the biggest problem now is I just don't think we have a very liquid market. I remember the choppiest. I wouldn't say it was a choppy market, but The most liquid market, is like 98, 99, 2000, where you could just get a ton done at a price. And I think it's a lot harder to do that now. So I think, sort of one thing, you've got liquidity in one hand and volatility in the other, and they're like stepbrothers or stepsisters of each other. But right now, until the public kind of gets back in the market, I think choppy is a good way to describe it. A little volatile and a lack of liquidity. And I think but I think from that point of view, it hasn't been like that. It might be kind of a new level for both of those things. The fact that the liquidity is relatively low and the volatility is relatively high. I'll say that.
Yeah, I think Andrew's spot on. I think what 2012 was the thinnest market I've seen in my career. And I go back to the 73, 74 when the Dow went from 1,000 to 500. You got a bunch of stuff going on. You have, to Andrew's point, the public is out. Much of the public is in ETFs. So a lot of that is being auto traded, and that's our end of day volatility. Dodd-Frank, the prop desks, I know I've talked about this a number of times. The prop desks are thinner to gone, so there's less real capital. If you look at the New York Stock Exchange specialist, when I started in this business, they took risk. Today, they're simply a marriage broker. They're looking for liquidity. They've been looking for liquidity upstairs for the better part of a decade. Now there's less and less liquidity upstairs with many of the prop desks gone. So you've got thin markets. And in fact, what you have here, to a large degree, even with the public out, is this market is dominated by what public paper there is. And, the mornings are very, very thin. The afternoons are where there seems to be a lot of this rebalancing of the ETFs and the professional buying, and you've got high frequency in there. So this market has, mood swings, and, one day it's risk on and one day it's risk off. I will tell you a telling indicator about this market and public participation. I live in a suburb of Chicago, and Comcast is dropping CNBC out of the mainstream, channels. It's moving it off to the side, which means nobody's watching CNBC. Let me clarify that. There aren't enough people watching CNBC, and that to me is a really telling indicator. And as I say, having been in this business for a long time, this is going to precede a big market event. And in my lifetime, all big market events, the rally in 74, the 87 crash, the 89 crash, all come off what is in hindsight low implied volatility for that period. So as this volatility continues to creep lower, I think we're setting up for a big event. And I don't know which way, but I think a lot of it is going to be driven by the events in Washington. And you kind of see this surprise nobody compromise, last minute, detail, and we're up 500 points. So that tells you how thin markets are. If they get anything really done in Washington, which as soon as that's out of my mouth, I know what everybody's going to say. It's just simply not going to happen. This market could take out highs, 1475 on the S&P could easily be gone. 1500 could be gone. 1600 could be gone. If they continue to fiddle in Washington, we go the other way.
Yeah, it's interesting. I think to your point, Alex, I remember back in 07, I still remember doing presentations in 07, and a lot of it was just on low volatility strategies, just because of the fact that I remember the VIX, I believe, was in single digits at the time. And we all know what happened in 2008. And that's another example of that. I remember just going to seminars and just talking with traders out there, and they're like, well, what do you do? You're not able to. People were kind of still had in their mind the tech bubble and the tech bubble bursting, and that was back in the days when you could actually do at the money covered calls for 10% on relatively safe, or what was perceived as safe, stocks at the time. And people didn't know what to do in the low volatility environment that followed the tech bubble bursting. So volatility is an interesting animal that more people need to pay attention to, in my opinion.
Yeah. Remember when you talked 10% and people were disinterested? It wasn't enough for return?
Yeah. I remember I went to college in the 90s, and I remember one of my teachers just going through on showing us stock market returns, and he'd use 10% as his example. And I remember just watching him make fun of that return. He's like, well, let's say we did 10%. You can do that standing on your head. We do this, and this. And it was unbelievable how much of a joke 10% was back then.
Yeah, now we've literally had a lost decade. No return on either side unless you've done something to enhance income, some premium selling, and but it's an interesting time. And to Andrew's point and Mike, to your point, I just think we're in thin markets. We've got a lot of the public either sitting on the sidelines or having parked their money in ETFs, and that's not bad, having parked their money in ETFs, but in terms of true active management and trying to perform better than the averages, there's been very little incentive in this last 12-month period, and markets are just thin. So, for the trader who knows what they're doing, for the trader who understands volatility, I know, Andrew, I've preached about this a couple times, but if you're going to be in the options market, you should have a good understanding of volatility. It's what I call the Goldilocks view: too high, too low, just right. And you should integrate that into your trading strategies. And, if you think vol's going lower, you should, be putting on strategies that will benefit from a decline in vol. One of the first things I was taught when I entered into the options market is if you're an active trader and you're wrong about trend but right about volatility, you may not lose money. And if you're an active trader and you're right about trend but wrong about vol, you may not make money. So it's important to get educated. It's important to understand. It's important to look at. I mean, the VIX, even if you don't trade it, is a great weather vane of what's going on, and it's important to understand what it means.
Well, very good. Very good. Well, that concludes our trading block for today. And now we're going to get weird with the unusual activity block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
And welcome to the Odd Block. This is the section of our show where we get weird. And who better to get weird with than the rock lobster himself, Mr. Andrew. Andrew, how can you weird us out today in this Odd Block segment showing us unusual activity?
Well, I've got a couple things. I mean, there was a lot of interesting activity the last couple days, but I thought I'd pick out a couple that were sort of germane to what's going on. So, but first, anybody ever see those little cars, the Zipcars going around? That company is actually getting bought out, or supposed to be getting bought out. And as a block, I thought kind of interesting. The Zipcar Feb 12.5 calls traded for 10 cents 3,000 times on a block, opening paper with 5,300 contracts traded, and that was yesterday. And I thought the 12.5 was above the deal price. I thought, somebody's basically taking a shot that that somebody might trump or might put in a higher bid than the one that was put off. What is it, by Avis Budget, I think, or something like that. That was the rental car company that's buying Zip. But if you're a Zip shareholder, you're going to not make any money, because if you bought it on the IPO at 18, you're going to get taken out at 12.5. And that's not so good. So anyway, I just thought it was interesting. People are buying some out of the money calls in Zip after the deal, possibly on the deal going higher. So I thought that not a bad little tell there. And a couple of really, really large VIX trades. Let's see here. I'm pulling the one up.
More people buying the 70 calls?
Exactly. Not as, let's just say not as, not as blatant as that. This one, I think it was just savvy. On the opening this morning, paper sold some Jan 17 calls at 50 cents. They sold 11,200 of them for 50 cents. And well, the VIX, bounced around today. I believe we have a close of around 14 and change. Let's see. I think my closing price was, 14.56. VIX down 12 cents today. That 50-cent sale is actually looking pretty good. And on top of that, I have total volume traded, I think around 75,000 contracts. So normally the VIX trades quite a bit, almost 500,000 contracts per day. The open interest on this thing was pretty big. Actually, it did not look like closing paper to me. It looked like somebody just whacking the bid and selling more of these things. So to me, that looks like kind of more of a bearish VIX call trade to me, but a pretty good chunk of paper. And another trade in the VIX, I thought this was pretty big. Now, this I thought was a closing trade. Like we said, the VIX made a kind of collapse from around, 22, 23 to about 14 over the last couple days. And somebody looks like they were closing a VIX put spread, just a little put spread though. The first blocks that came through, I counted around 22,000 contracts. Looks like they were a seller of the spread because it traded through the bid on one side. And I'm going to look at the open interest tomorrow, but it looks like somebody was long the 14-17 put spread. I had 22,000 contracts trading at the time. The volume the spread volume went up to almost 60,000 contracts by the end of the day for about $1.56. So it looks like they probably bought a put spread for darn near nothing and sold it out, 50,000 over 50,000 times is pretty big. They've been selling it out in chunks for around $1.58. So, I think some pretty good profit taking. Here's just something for people that like the volatility, especially for an odd block. The 30-day implied volatility for the VIX, we want to talk about cheap implied volatility, is down to around 69%, which is pretty low. The 10-day realized volatility, though, in the VIX, the actual movement of the VIX, is 198%. So the VIX has had quite a wild ride, and some people have definitely been making some money trading it. So I think I was trying to find the opening price for that time spread. My guess it probably was on the right around 25 cents or something like that. So he made some pretty good coin there. Nothing like making $1.25 around 50,000, 60,000 times. So again, that's my odd block activity. We got a takeover. We have a couple of VIX spreads. One taking profits. Another just selling, some good old January calls that they think are going to go out worthless. And that will do it for the odd block for me today.
All right. He even provides his own transition for it too. I love it. All right. And that concludes the odd block for today. And let's dive right into the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
And welcome to the Xpress Block. This is the portion of our show where Mr. Longo usually likes to say, sit back, sip on his mojito or his brandy, whatever the case may be, and rest his voice, and we'll listen to the wise words of Mr. Alex Jacobson. Alex, what do you have for us today?
Well, a couple things. We're early in the year, but earnings season begins next week. Alcoa, which is always the early part of the earnings season, posts on the 8th. So possibly by next week, we'll have politics out of the market to some degree. We'll obviously never have politics out of the market, but we'll start to get earnings next week. So we'll get some fundamental drivers back into the market with Alcoa on Tuesday. And here at OX, as I mentioned, the internal long put call has gone 3-to-1 calls to puts. The internal short put call has been sitting right around 8-to-1 puts to calls, and that has not changed much. But the long put call has come in a lot. So there was clearly a lot of put buying, either year-end hedging or fiscal cliff speculation going into the end of the year. And our calendar restarts. So a couple events. The crew will be in Sacramento on January 12th, and they'll be in Minneapolis on January 26th. That's a seminar cycle. Those are all free. And everybody, clients, people who just want to learn more about options who aren't OX clients, are welcome to attend.
Wonderful, wonderful. Yeah, I always like it how I've mentioned to Cusick a few times how he always likes to send people to Minneapolis in January.
Yeah, well, when I did institutional for both the SIBO and the ISE, that was one way to endear yourself to customers. And when I was at the SIBO, IDS was still up in Minneapolis, and you'd always go up and see them in January, and they were genuinely appreciative of it. I mean, Minneapolis, if you've never been there, is not saying it's not a tough town in winter, but the buildings are all interconnected. They all have these above ground walkways.
Yeah, they have those. Yeah, you're right.
Yeah, much like Toronto has underground. So after your first appointment, you never have to walk outside. So it's a great city. It's a fun city. Used to have a fair amount of institutional business up there. In fact, the building used to be the IDS Tower. Investors diversified. They're now the fund manager arm of American Express. But crew will be up there on the 26th.
That is good. That is good. Yeah, I still could never talk Joe into sending me to Honolulu, even though at the time it was Options Express's 26th biggest market, but he didn't quite buy that. So anyway, that'll do it for the Express block today. And let's dive right into the strategy block.
The strategy block.
And welcome to the strategy block. Today, I need no introduction. Since I'm doing it myself, I'm not going to introduce myself. So with that, I want to talk a little bit about how options don't involve just the market going up and the market going down. I want to expand a little bit upon what Alex was talking about and Andrew were talking about earlier in the show in regard to how volatility and how you can look at the VIX maybe as a weather vane, or you need to have an understanding of volatility in the option market. And with this strategy, I want to talk about selling puts, and I want to tell you a story about something that happened to me a couple years back, probably about 7 or 8 years ago. A nice lady had come up and said, "I'm new to option trading, and I really don't understand what happened." And I said, "Oh, well, how can I help you?" So what happened was she sold a put. Now, by selling a put, that's technically a bullish move when it comes to the direction of the underlying. You're hoping that the market goes up by just simply selling that put. That's all she did. It wasn't a combination, wasn't a spread, nothing like that, just a good old-fashioned short put. So anyway, it was an out-of-the-money put. I don't remember what the exact prices were, but let's just say the stock was trading at 27. She sold the 25 put. And the stock went down from 27 to 26.5. And she's looking at it, she's saying, okay, why I see the stock went down, but the value of the put also went down. What is this? Why is this happening? So I looked at her account and I said, well, the first thing is that you need to thank God that you're going to learn this lesson on a win and not a dramatic loss. Like a lot of people seem to learn this lesson the hard way in the market when they don't get educated. Second off, let's take a look at this. When you trade options, it's not just a one-on-one battle. It's a six-way battle royal. You have 6 different factors of option pricing. You have strike price selection. You have movement of the underlying. You have implied volatility. You have interest rates. You have dividends, if there are one. And I forget which one I didn't mention. Oh, and time decay. And so you have all these different things battling each other. Delta versus theta, theta versus vega. You have all these different things going against each other to where a lot of different things can happen. So what we did with this woman is we examined all the different possibilities as to why the value of this put could have gone down. So we started off with delta. Well, the stock went down, so it wasn't delta that was causing the value of this put to go down. So we had to throw that out the window. Next thing we checked was time decay. Well, this was about a 1-month option, and it had been maybe 2 days since she had gotten into the position. And so with that, the value of the option went down by about 50%. So it really wasn't time decay that was causing the value of this option to go down in value. It didn't add up. Interest rate really wasn't a factor, and the stock didn't pay a dividend, so it wasn't either of those two things. So what that left was one possibility, and that was implied volatility. So what happened on this stock is that the implied volatility on this option went down significantly. So explain that to her, and then just to kind of go through it a little bit deeper, I wasn't familiar with the stock, but I said, okay, well, maybe the stock had an earnings announcement in the last couple of days. So we did some digging on the old OX quote detail, and sure enough, we found out that this stock had an earnings announcement. Now, the earnings were nothing out of line or nothing crazy, but there was a lot of anticipation going into earnings that there might be some type of big move. So because of that, what was happening is that there were a lot of institutions, there was a lot of people in general buying options because there was an anticipation of a big move in one way, shape, or form. And that drove the price of the options up. Now, after the earnings announcement, it turned out to be a real snoozer or a real non-event. Then people thought, oh, well, okay, this isn't going to be a big issue, so I don't need these options anymore. I'm going to sell all these options. Now, of course, it's a little bit more complicated than that, but a lot of times after a major event, if it becomes a non-issue, then implied volatility will go lower. Not every time, but a lot of times it can, and that was an example in that case as to why it was happening. So when you're trading, folks, if you're selling a put, you have to have an understanding a little bit about how it works. Now, me personally, I do not like to sell premium going into a major event. I think that's just a dangerous game to play. It's just something that I don't like. Major events with my systems and what I do are just kind of a nuisance to me. I try to just hedge around them, so to speak. But if you are going to play a major event, understand the risk before you get in it. There was a lot of perceived risk in the marketplace in this example, and this woman was not aware of that. Now, maybe she still could have sold the put, maybe not. I don't know what her exact situation was. But my point is, have an understanding of both the perceived risk through the implied volatility and your perceived risk. Folks, whenever you make a trade of any kind, you're saying that the market is wrong. If I'm going to buy XYZ stock at 50, I'm saying that the market's wrong. I'm saying that that stock is cheap. I think it's going to go higher because that's why I'm buying it. I think it's going to go higher. And if I'm going to sell a put, I'm saying, okay, the market is wrong, and I think that volatility is going to go down. I think the market's going to go up. Whatever the case may be, just understand what you're actually doing and have a firm understanding before you actually get into it. And that, folks, is the strategy block, the first strategy block of 2013. Now, I'm going to dive into listener mail.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, we have a question today, and I think this will be a good question for all of us, actually. So let's go ahead and read it and throw it out to the peanut gallery, and let's see where it takes us. Hey, Mark, I love the radio show. I find myself wanting the next show because I learn something new every episode. My question is, how should a trader handle stop losses on a naked call or put and or a vertical spread? When should you call it quits? IBD mentions 8% for stocks, but at what level should it be for options? Thanks, Chandra. So, Alex, I'm going to start this one off with you because I think this one, there's a lot of advanced orders and things like that Options Express has to offer that you might be able to help our listener on.
Yeah, well, there's two ways to answer the question. And to your point, you have the ability at Options Express to set real stops and to not have to monitor them. But I'm going to go to the psychology of the question more than the mechanics of the question. So wherever this questioner trades, hopefully you have a platform that's robust enough to allow you to put stops in or trailing stops. And again, you can do all that here, but that's not the core of the question is, how do I set stops? And this was something I was taught years ago, and I suspect both of you guys are going to have an analogy similar to this. But as soon as I enter into a trade, I know I want to establish what I call a threshold of pain and a threshold of panic. And my threshold of pain on an uncovered option or on an option spread, I'm going to establish it based on the underlying stock. So if I've sold a put 10% out of the money, I'm going to have a threshold of pain with the stock declining around 4 or 5%. And the threshold of pain is the point at which you reevaluate the position and hopefully you don't begin lying to yourself. And that's one of the things with setting stops that always troubled me, because people would say, well, I bought it at 40 and I thought it was going to 60, but if I know if it got to 36, I was going to get out of it. And then it got to 36 and I realized that was the Fed or having Congress in our grill. The issue with the mental stop is everybody psychologically plays with it and finds an excuse for not pulling the trigger on the mental stop. So the threshold of pain is the mental stop. The threshold of panic is the hard stop. And at the threshold of panic, maybe 6% or 7%, you mentioned IB talks, 8% on the underlying, I'm out. The most successful options trader I ever knew, I mean, literally somebody who made hundreds of millions of dollars in the options market, was a card counter. Prior to that, he was actually a rocket scientist. But whenever you tell the story, you say, is a card counter a gambler? And, half the seminar room will look at you and say, I'm not sure. You'd say, nope, they're a risk manager. And what a card counter does is bets frequently small, loses frequently small, and every once in a while hits a home run. And you got to have the same attitude. A second point to make about a mental stop is if you get a jump in implied volatility, as you pointed out a little while ago, Mike, there are multiple factors here, and it isn't just price alone, and it isn't just what my platform allows me to do, but there's the issue of implied volatility. And I'll say this again, I can be right about trend, but wrong about vol, and I may lose money because of that. So you have to factor in not only a number that is an underlying move, or I sold it for 4, I'll put an order in to buy it back at 5, but think about the issue of implied volatility and look at the big market events. And a lot of times, story about the 87 market break. And I worked at the SIBO back then. And one story we like to tell is who lost the most money in 87. And the knee-jerk reaction is it was the put sellers, which wasn't correct. It was the covered call writers. Bad analogy, but the reason the covered call writers lost money is because stocks went down and vol went up. They lost money on their stock side and they lost money on their option side because of the big jump in implied vol. So now that I've frightened everybody out of covered call writing, which was not the intent, keep in mind this issue of implied vol. And again, develop a Goldilocks view of volatility for every instrument you trade. Every weekend, go, if you're an Options Express customer, Schwab customer, come to the site, look at the implied vol, the at-the-money put call, write it down. If you're technically inclined, put it into Excel. And within a few weekends, you'll have a sense of what's too hot, too cold, or just right, the Goldilocks view. If you're new to trading, the CBOE calculates, I think, 16 or 17 volatility benchmarks. It isn't just the VIX. On the S&P, they calculate volatility on the NASDAQ. They calculate volatility on gold. They calculate volatility on crude oil. Yes, they calculate it on the S&P, the NASDAQ, and the Russell. But they also calculated it on Apple and IBM and Amazon and Google and Goldman Sachs. Look at that number and you'll intuitively develop what's a good volatility for the instrument you trade.
Andrew, what are your thoughts?
I don't like the simple rules. I don't like a loss on one trade to be more than a loss on another one or a gain. So you don't want a loss on one trade that's going to take you 10 trades to make back. So number one is whatever you have to do, I think, has to be put in that frame of reference. So IBD says around 8%. I think you could give yourself a little more room than 8%. 8% for an option. On an option that's $1 would be 8 cents. So I don't know if that gives you a particularly lot of room. In general, I don't want you to lose more on a short option than you can make for the full pop selling it. So you sell an option for $1. Don't allow yourself to lose more than $1 on it. And it takes some pretty darn good effort on an underlying to lose $1 on a $1 sale. So that's giving yourself plenty of room to still be right. But once you get to that point, you got to, like Alex said, you have to look at yourself and say, how right am I? Because the market right now is telling me not. So I kind of use those limits if you're going to sell options. Selling naked calls and puts, you also have to really ask yourself if you have the size account for that type of trade, for the very reason you just don't want to wake up one day and your account's gone. So even if you have a $15,000 account, and you have to understand the difference between margin and risk. So just because they let you margin it doesn't mean it can't zap you one day. So I would recommend most people to sell spreads over a naked option unless you can properly allocate the types of positions in your portfolio. And that's basically how I would handle how you look at losses. And have your plan before you go in. If you sell a call for $1 and it goes to $2, are you still breathing? Maybe you might decide, well, maybe 50 cents, maybe 50% loss is what we call that at Option Pit, your absolute max loss. We don't want you to go over that. So you absolutely close. And it might be a little aggravating because you might be picking the bottom, but at the same time, you never know when a day could be a crash, like Alex just said, and you'll be thankfully you closed your $1 put for $2 because it went to 25. So, and that's really the main reason why, I use those numbers. So once you start pushing up against that, it's time to reevaluate and close. So we have two numbers. We have a max loss and an absolute max loss. The absolute max loss is half your premium that you sold, or your max loss is half your premium, and your absolute max loss would be the full premium that you expected to take in. So if you get to your max, which is half, you reevaluate, make sure that you actually want to stay in the trade, possibly adjust. If you get to your absolute max loss, which is a loss equal to the premium you expected to take in, close it. Because by then, it's almost easier to close it then, have a fresh mind, relook at what's going on, and you could easily start selling options maybe 5-10 handles lower. The volatility's going up, but you're going to get a much better price. You can be profitable on the new trade, probably make back the money you lost on the old one, and it gives you a better chance to really re-enter. So, and that's why I would say do that, because usually when you have a loser, you tend to focus on it, your eyeball doesn't leave the screen, and you keep going, oh my God, I should have closed it. Oh my God, I should have closed it, instead of having it closed and just watching the market run. And then you can decide with a let's just call it a clean slate.
I think that makes sense. I think that makes a lot of sense. When you focus on the losers, it definitely clouds your judgment. That's for sure. And one thing that I like to do too is I like to set up a system in one way, shape, or form. The simple version of what I like to do is whenever I'm at a point to, like, let's say I'm looking to make $1 on either the naked option or the spread. And keep in mind, when I say naked option, I'm referring to something cash secured. I seldom, if ever, go on margin or leverage ourselves for such a thing. But whenever I'm looking to do it, let's say I'm looking to make $1, as soon as the position is at a point to where I'm losing $1, that's my, I guess as Andrew would put it, that's the absolute max loss. Or I'm sorry, that's the max loss, not the absolute max loss. And so at that point, I want to, unless I see some type of, and I usually don't, unless I see some type of opportunity to where, oh, well, these puts are trading at such a low level right now. There's such this weird vol crush in these at the money puts. And if I use that makes it a real cheap hedge. If it's a situation like that, then I would stay in it. And I would set up some type of hedge to stay in the short option or the short spread. But if I don't see anything real good, real fast, it's time to get out. And by doing it that way, if you're just right, if you're right 7 times and wrong 5 times in a month during the year, you're a profitable trader. You only have to be right one more time than you're wrong. Now, let's say that I'm losing 10% and only gaining 1% every time. Then you can't be wrong that much. And let's face it, as traders, yeah, we're going to be wrong. You better only be wrong like once every 6 years. So you have to have a system that makes sense, and the numbers have to add up on it. So with that, that's my take on risk management. And let's go to Around the Block, guys.
Around the Block.
And welcome to Around the Block. Let's go ahead and see what everyone is watching in these upcoming days. Andrew, what is going on over at the pit, or what are you guys watching in these markets?
We are, really how low volatility can go if we actually can continue to weaken without the big, without the big news coming. Like I said, I'm saying this is a short-term thing. It's not a long-term thing, probably up until the earnings cycle where things start to sink a little bit. But other than that, and, actually looking for trades that actually are some, I know it sounds weird with the volatility low, but looking for some sort of protected short volatility trades, like time spreads and strangle swaps and stuff like that, where we can kind of sort of use this probably quiet period to generate some income, and then possibly, like I said, and have a little and have some options for when things probably start moving again. Which who knows when? I mean, could be tomorrow after non-farm payroll, but that's definitely on our radar screen for tomorrow. The ADP report looked pretty good. It's not always probably a 50 delta on how good that is a portent of the non-farms payroll, but again, more better news than not seems to be coming out. So, and I think that's still the trend. So also, what are the market return over the last 2 years? Why 10% this year and 0% the year before? So we've basically been rolling on 2 years of pretty low equity returns, or probably I would say subnormal. So we'll see if Washington can fix a couple of things and stop spending so much money. We could see a decent rally this year. So that is my early prognostication for 2013. But again, I think we are still beholden to governments to some, unfortunately, that the government has crawled too much into our kitchen, into our equity market kitchen at this point. So we're kind of stuck with them till they get the deficit down to around $100 billion or less per year.
the house guest that won't leave. Alex, what are you guys watching over at Options Express?
To Andrew's point, earnings next week. I mentioned Alcoa. We get Monsanto. Also in line with Andrew's point, I think earnings could be a little better than expected here. I think the news could be a little less onerous. Government is still there the entire time, but it will be interesting to see the first numbers. We had car sales today and they were good. GM bounced off a high. So things are getting better in the economy. You know, everybody kind of speculates on real estate and employment numbers. I think can be spun almost any way you want, especially real estate numbers. You know, if you're looking to buy a house, you'll see what you see in the numbers. But car sales were good. Employment so far looks a little better. Interested to see what starts to come out of Alcoa. We get good earnings next week in this kind of thin market. We could see a really nice pop. We could see a continuation of what we've had so far this year. So keeping my eye on the earnings ball.
Definitely. And you mentioned you have events coming up in Sacramento and Minneapolis. Anything else on the horizon at Options Express?
January 12th, Sacramento, 26th, Minneapolis. We have an active webinar schedule. You can come to the site. Everything is free. Nina, who sits one down for me, was just finishing a webinar as we were starting, but there's an active webinar schedule, both options, equities, and futures. We bring in a handful of outside experts, especially in the futures area. So lots of great content.
Wonderful. And Andrew, what do you guys got going on over at the pit in the near future?
Okay, so basically, you know, we just have all the good old stuff that is at Option Pit. Option Pit Live, which is probably still one of the best educational resources for 1 hour live market segment every day. We actually teach you what's going on in the markets instead of just saying, you know, go buy this because of this reason. So we actually look at volatility. We look at all that stuff and break down what the market's doing. So I think it's one of the better deals for education. And it's a heck of a lot cheaper than taking, you know, a bunch of money and throwing it at options. You can actually spend a year and learn how they trade first. For a fraction, I guarantee most of our clients are refugees from other services, so who have spent multiples, many multiples, on what it takes to take some option pick classes. So, and once they get here, they're generally happy they are. So,
well, that is good.
That's it for us.
All right. And at Reliance Capital Markets, it's hard to say, still not used to it yet, formerly Know Your Options. The webinar train will be rolling in full swing in a couple weeks again. We have a couple of things scheduled, but nothing is out as of yet. Just have the handshake deals going. And the hopes that Mr. Sebastian will come on for us too. We're excited, and keep posted. We will be in touch. And that concludes today's episode of the Option Block. Our thoughts are with Mr. Longo. Hopefully he feels better and can be back with us in full swing come Monday. But in the meantime, I'd like to thank everyone for coming and wish everybody well. And let's have a successful trading year in 2013. So long, everybody.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.